Fraud has become the most prevalent crime in modern business, accounting for 41% of all crime against individuals in England and Wales. Over £1.1 billion was lost to financial fraud in the UK during 2024, with identity fraud reports surging to 421,000 cases, a 12.5% increase, and a 76% explosion in account takeover incidents. Across the EU, losses reached €2.8 billion to EU's financial interests and €4.3 billion in payment fraud. These statistics signal a fundamental shift where organized and sophisticated fraud outpaces traditional crimes, often facilitated by weak or corrupt insiders. This demands comprehensive responses from organizations, particularly as new regulatory frameworks impose unprecedented accountability. A stepped-up corporate accountability. The Economic Crime and Corporate Transparency Act, 2023, introduced on September 1st, 2025, a new corporate criminal offense, failure to prevent fraud. Organizations are now directly liable for fraud committed by associated persons, employees, agents, and subsidiaries that benefits the organization or customers. Consequences include unlimited fines, profit confiscation, victim compensation orders, and reputational damage. Exposure scenarios include greenwashing, finance staff manipulating figures, sales teams providing false tax information, or directors making misleading statements to induce sales. Organizations can defend against liability by demonstrating reasonable prevention procedures. The comprehensive guidance from public agencies like the Crown Prosecution Service, Serious Fraud Office, and Financial Conduct Authority offers more than compliance. It offers a powerful framework for analyzing organization response in all sizes. Beyond compliance, a framework for transformation. 6 core principles provide a lens for defining and implementing fraud management programs, representing opportunities to strengthen fraud resilience and risk culture. They focus on internal attitudes, roles, processes, and mechanisms, revealing gaps between stated values and actual behaviors. Top-level commitment. Setting the tone. Leadership commitment forms the foundation. Organizations must articulate genuine commitment to conducting first-class business in a first-class way, ensuring role holders are fit and proper, with anti-fraud messaging reflecting reality. Effectiveness from top level requires clear governance frameworks, the 3 lines of defense, along with robust mechanisms for maintaining governance during absences and crises. Organizations must maintain detailed records of debates, rationale, and decisions, while ensuring leaders walk the talk through consistent example setting. Whistleblowing mechanisms should be robust and, where appropriate, transparent rather than shrouded in unnecessary secrecy. Risk assessment. Understanding the threat landscape. Effective fraud prevention begins with understanding where vulnerabilities exist. Organizations must conduct dynamic, documented risk assessments informed by peer experiences, operational reality, creative thinking, and scenario planning. The guidance recommends approaching risk assessment through the fraud triangle framework, examining opportunity, motive, and rationale for committing fraud. This requires moving beyond static annual reviews to embrace data analytics, sometimes behavioral, for identifying anomalies, regular what-if exercises, and both inherent and residual risk assessment. Organizations must understand fraud psychology, recognizing that motivations and opportunities evolve. The challenge lies in balancing thoroughness with practicality. Proportionate risk-based procedures. Building defenses. Control procedures must be proportionate to the risks identified, tailored to the organization's specific circumstances. This principle demands clear documentation, justifying decisions, avoidance of duplication, and realistic expectations. Organizations face the proportionality conundrum, balancing feasibility against desirability, conducting cost-benefit analyses of controls, and accepting that zero-risk environments don't exist. This may mandate a comply or explain approach, creating adaptable frameworks reflecting genuine risk rather than box ticking. Organizations must be willing to rethink structures when evidence suggests better approaches. Due diligence. Strengthening the perimeter. Organizations must implement robust due diligence for all who act on their behalf: staff, consultants, vendors, and service providers. This includes risk assessment, need-to-know protocols, segregation of duties, and appropriate data access controls. Historical vendor or consultant landscapes must be understood and addressed, particularly during acquisitions, divestitures, or transition situations. Technology plays a crucial role, from third-party risk management tools to screening systems. Organizations must balance technological solutions with human judgment, particularly facing emerging risks from cryptocurrencies and AI. Fighting AI-enabled fraud, like documentary or deepfakes, increasingly requires AI-powered defenses, but human capital remains irreplaceable. Communication and training, building vigilance. Effective fraud prevention requires that all stakeholders understand their roles and responsibilities. Organizations must leverage internal and external communication channels, demonstrating empathy with stakeholders, while clarifying what data can and cannot be shared. Engagement with industry bodies, peer groups, and law enforcement agencies provides valuable intelligence beyond generalities. Training must evolve beyond traditional lecture formats or canned video clips to embrace innovative techniques that foster engagement and commitment, involving outsiders when it makes sense. Culture mapping, ethical dilemma simulations, risk scenario exercises, and post-mortem analysis of actual cases can create blame-free safe spaces for learning. Experiential training on realistic scenarios provoke reflection and discussion, provided appropriate warnings and support mechanisms are in place. Monitoring and review. Maintaining momentum. Effective monitoring encompasses three elements: detection of fraud and attempted fraud, thorough investigations, and continuous assessment of prevention measure effectiveness. Organizations need meaningful performance metrics, including both leading and lagging indicators, real-time monitoring capabilities, and the ability to identify systemic weaknesses beyond individual incidents. The challenge lies in balancing comprehensive oversight with alert fatigue, demonstrating prevention value when success means incidents that never occur, and maintaining investigation objectivity. This requires multi-layered frameworks and collaborative intelligence sharing internally and across the industry. Cultivating a risk culture. These 6 principles reveal something profound. They're not merely compliance requirements, but diagnostic instruments exposing the true health of organizational risk culture. The evolution from sterile command and control, through sometimes adversarial trust but verify, to optimized, sustained risk-aware collaborative risk management, represents a fundamental shift in organizational thinking. A mature risk culture requires acquiring and applying a risk mindset at both individual and team levels. This means following both letter and spirit of regulations, seeking advice, including contrarian perspectives, relating frameworks to real-life situations, and embracing evolving technology even without complete understanding. Organizations must nurture the ability to influence, advise, and conduct action-oriented research while encouraging calculated risk-taking, even trying to break things to identify vulnerabilities before fraudsters do. Ultimately, the duty to prevent fraud presents both challenge and opportunity. Organizations viewing it merely as compliance burden miss potential for strategic advantage. Robust fraud prevention frameworks can differentiate organizations in attracting customers, partners, and talent who value ethical practices, transforming regulatory obligation into competitive edge.